an advanced class. It's an advanced strategy. And then, with advanced strategy, it is for people that already started trading. If you have not started trading, there's no way you can advance. I'm sure we all agree with that. So basically, we're looking at an advanced formula. Now, I call this the winner's trading formula because by the time we go through the class, right, I will show you, and you would all agree with me at the end of the class that it is really indeed a winner's formula, because it's different. It's a combination of all of the things you might have known separately. So basically, in today's class, we'll be looking at a bit of Fibonacci, we'll be looking at a bit of hedging, we'll be looking at a bit of the martingale principle. Now, these are things that I'm sure that we might know, if not all of them, one or two of them. But I'm sure also we can combine all of this and have a different trading strategy from what we have been doing before. And I'm sure that at the end of the class, you will agree with me that you will see the difference between what you have been doing and what you ought to be doing with this trading formula. So let's just get started. So the winner's trading formula advanced premium workshop. Now, the winner's trading formula basically is just a formula that enables trader to do what? To have consistent profits. Now, I'm sure that basically the reward for traders, you all agree with me, is profit. So it sort of defeats the purpose when you're trading and not making profit, yes or yes? And then you can see that beside me here is a book, right? And you'll see that the book, if you look at the book title, you see that it's a book that was written by a consultant in the industry. And basically, this trading formula was derived from the activities and the observation of this book. And then this is not a book that was written in a rush, right? It's a book that was series of research, in-depth research, as I will show us as we go through the class. So basically, I said the winner's trading formula is like you make traders have what? Consistent profits. It's a consistent profit trading course for advanced traders based on this book. And the book is what? How to recover from trade losses. Because I'm sure that quite a number of us might have experienced losses at one point or the other. The truth is, even myself personally, when I started off as a trader, at some point, I got frustrated. But the moment I got a winning formula, I realized that all of those my so-called frustration was because I was doing some things wrongly. And basically, we'll just share those experiences with us today. So, the book I told you was written by Sonny Oroge, right? So let's see, who is Sonny Oroge? Now let's look at the profile for Sonny Oroge. So we can see this is the profile for Mr. Sonny Oroge. You can see both his educational and his professional qualification. Now, the reason why I'm going through this is for us to understand that this is not a trading formula that was just cooked up or something that was just done in a hurry. This is something that was done from someone, look at his background of study. So you can see BSc in economics and statistics, and you know that you agree with me that trading has a lot of economics and statistics in it, a lot of mathematical calculation. Yes, we tell you that you don't need to know that in depth to become a trader. But the truth is, we cannot remove that completely. Yes, you don't need to be like a great mathematician or an economist to become a good trader, right? But you can anchor on the knowledge of such people. So an economist or a great mathematician or a statistician has gone through the effort to do a research. I could come from an art background and just leverage on that knowledge he has, or the experiment or the research he has done over the years, and then use it, apply it to my trade and make profit from it. So you don't have to be the originator of it. You don't have to be the great economist. All you have to do is to seek that knowledge from that economics and apply that knowledge correctly. And you can see that he has experience. He has over 35 years experience in investment banking, right? He has He has traded actively both in the Nigerian Stock Exchange and in the New York Stock Exchange. You can see that he's a former managing director. He has worked in various stock brokerage firms and even got into the position of CEO, proficiency and certification up to advanced option trading from the Options Institute in Chicago. So you can see that he has a whole good profile. You know, most times, like I used to say in my class, that when you want to follow, we used to say follow who no road, Abby. Please, if you look at the profile of this man, I'm sure you agree with me that he has gone through a lot. Now, you don't have to go through all of this experience, like spend 35 years getting all of this experience for you to enjoy the knowledge from here. And that's why Rally Trade, in collaboration with Sonny Oruge, is bringing you the Winners Trading Formula class. So enough of this profile, right? Let's look next at so first, let's look at basically success in life and in business is all about strategy. Remember, we're looking at a winning strategy. And I am of this notion. There's something my boss taught me. He said, life is a game and you have to play that game to win. Now, everybody that engages in a game realizes that your strategy towards that game or in that game, it what keeps you in that game or what causes you to win. And the truth is, life also, so for instance, for me, I take it that trading is part of life. So for me, trading is part of life. Now, some people might disagree or say, oh no, I'm just trading part-time and all of that. If you are trading part-time, the aim is to make money. And the truth is, almost everything we do as adults, we're trying to get money. So basically, if you are trading and making money from it, whether it's part-time or it's full-time, it's something you should take seriously. And it's something you should have good strategy, because the extent to which you succeed in this game called life, or in the game of getting money or getting more income, the extent to which you succeed is the extent to which you have a strategy. And the truth is, it is not just any strategy. You need to also have a good strategy. So for instance, what is a strategy? A strategy is just a plan of action, right? A strategy is a plan of action designed to achieve a long-term and overall aim. A plan of action designed to achieve a long-term and overall aim. The art of planning and directing overall military operations and movements in a war or battle. Remember, I told you that life is like a game. Some people will tell you life is like a war. Now, whatever part you are, whatever school of thought you belong to, the basic thing is that you need strategy to succeed in every part of life. And then the extent to which your strategy is good is the extent to which you will succeed. Now, let's look at, for instance, how many of us are movie lovers? Now, if you're movie lovers, you probably have watched this movie, 300 Spartans. Now, you'll see how this man was able to defeat great army with little number of men. And you see that the only thing that enabled him to achieve that was because he had a strategy. I'm just trying to buttress the need of having a strategy. Now, he didn't just have a strategy, because I'm sure every military knows that. Every military or every army formation already knows that they should have a strategy. But the guy had to look for what? A good strategy, a winning strategy. So I often tell traders in my class that, yes, it is good enough that you are coming to class and learning everything that everybody is learning. But among all of the strategies, because you agree with me that in rally trade, we often give you numerous strategies. Now, that is because we are an academy. So we are responsible for giving you every strategy possible that is out there. Now, it is not left for you. So it is not left for you to, okay, today they are teaching Fibonacci, and today they are teaching this strategy. Amongst all of those strategies we have taught you, right? And you have tested it. I expect that you should pick out your own winning strategy based on the goal you are trying to achieve. Because not all of us might be trading, but all of us are definitely trading for different purposes. Yes, it might all be money, might be the end goal, but somebody might be trading as his sole aim of means of income. Somebody might be doing it just by the side. Okay, if I make $5 today, I'm fine. If I don't, no problem. Meanwhile, to someone, that is his all in all. So amidst all of this, you must find a winning strategy. And if you look back this movie, for those of us that have watched it, that was basically what this person did. He knew he had a disadvantage already, and then he looked for a strategy that will help him win great armies. he didn't just go into the open field to expose all of his men. He made sure that he was able to control the battlefield, making his enemy to come and meet him at his advantage point. So basically, we all need to have similar strategies. So for the sake of this course today, right, what we'll be looking at, right, we'll be looking at basically, so the content for this, we're looking at the main course, the vision and mission for the course, right? We're looking at what? We're looking at the course goals and objective. We're looking at the excitement. We'll touch on some of the excitement and frustration of currency trading. Now we'll look at fundamental truths about the currency markets. We'll look at this trading formula. What is it? We'll look at what the trade symmetry and trade charts are. We'll look at theoretical background. We'll look at we'll do a bit of an introduction to Fibonacci. Now, we're not going to dwell so much. Yes, the strategy entails Fibonacci, but we're not dwelling so much on the Fibonacci concept. I'll just give you a bit of the background and how it relates to this trading strategy today. We'll also look at a back test of this strategy, because the truth is, a good trading strategy should have been tested, and then there should be a result of that test. I always tell traders, every time you learn a strategy, don't pick that excitement and just run off. Have a system where you can test it or back test it for a while before you get to take it or adopt it as a full strategy. Now, we're also going to be looking at what summary of the back testing that we have done. We'll provide you with that summary. We'll be looking at multiple positions with increasing net profits. We'll also be looking at the PSMRM table. Now, this table basically helps you with risk management. It's a table that helps you with risk management so that you're not just picking lot sizes based on what you feel or what you think. There's a table that will guide you through, and that table is based on your account size and then the leverage on the account you're using. And then also, we're going to be looking at typical winning results from the backtesting of the strategy. And then we'll be looking at generally the limitations, the advantages and the limitations of this strategy, because most of the strategies often have, as good as they have the advantages, they have some limitations. Now, generally, so that you can be aware of what this strategy has to offer, and then you can backtest it, and before you get your final results. So basically, the objective of this class is to create a Fibonacci trade symmetry using the winner's trading formula. It's also to get you to do what? To determine the number of lots for trade entry using this risk management table I told us about. So you're going to use a table to determine the number of lots you should enter. And this number of lots, like I said, it is based on your account size and also the leverage on the account you're using, because different accounts will have different leverage. So based on the leverage, you'll be able to determine what lot size to start up your trade with. We'll also look at setup of trade position to close simultaneously. Remember, I told us there's also hedging included in this strategy. So we're looking at trade setup, how to pick up trade setup that will close simultaneously and close you in profits. Because I'm sure that most of us might have, at one point or the other, been in a situation where you have both a buy and a sell. So you have hedge positions, and then the challenge now becomes, at what point should I exit this trade? At what point should I exit the buy for the sell to come into profit? At what point should I exit both of them? So now, in this particular class today, I'll just show us how we can have identified trade setups and place trades that will still close simultaneously in profit, even without you necessarily being on your chart or on the edge trying to understand where to close the price. Now, we'll also be acquainted with the knowledge and application of the primary rules of this strategy. We'll also look at awareness of the limitation of the WTF and the way forward. Now, we'll look at the ability to scale out or scale down lots for price action recovery. We'll look at, we'll run trade losses recovery using the trend reversal channel. We'll also utilize, look at the utilization of volatility and application of direction neutral trading system. So irrespective of the direction, we'll still be able to place trades simultaneously, place buy and sell trades simultaneously to get to make profit. Now, all of these things, I'm just trying to read through these objectives for us. Once we get to the practical side, when we get looking at the chart, most of these things I'm reading out to us will make more sense from it. So at the end of the goal is that after this short session we're going to have, I said that participants should be able to use the trading formula, right, to create a system where they can make consistent profits. Like I say, the goal for a trader or the reward for a trader is profit. Now, I have realized most times that the problem is that most times we're not able to maintain that consistency in profit level. So today we're in profit, tomorrow we're out of profit, and all of that. And basically, that is the reason why we have put together this winners trading formula, right? So that we can be able to not just achieve profit level, but also have consistent profits over our trading period. Now, by understanding and using what the system rules and principles. Now, we should also, the goal also is that traders or participants from this class should be able to set up trades with any of the currency pair that the WTF and the pair risk table has. So we have some starting outlines of, we have about 11 currency pairs that we have tested this trading formula on. I'm going to reveal it to us later on. Now, we should also be able to place all required orders that can recover trade losses and make net profit upon exit. So we should be able to place recovery trades, because like I was saying, sometimes what traders do is, when I place a trade, for instance, I place a trade on Euro USD, I have a buy trade. And for some reason, instead of going up, it starts to go down. And then I begin to doubt my analysis, I begin to enter panic mode. And the next thing, I quickly place a sell. And then I am now stuck between a buy and sell, not knowing when, because what happens majorly is that most often the error that traders do is to open the same lot size. So by the time one of the trade is going in profit, the other is increasing also in loss. So thereby giving you a net that is still in loss. And then soon enough, it sets into trading frustrations and you are not able to come out of it. Now, with the winners trading formula, we will still be able to place what? Simultaneously, we will be able to place multiple trades in different directions and then still close them out simultaneously at a profit. Now, we should also be able to look at what? To be able to switch strategies and then look at the limitations of this trading formula. We should be able to trade live with the WTF on our MT4 platform using either a demo or real account. Like I said, every time you get a strategy, my advice is often try it out for a period on your demo account. Understand, pick out all the, because the truth is, in one particular class, you can hardly get everything. But mastery comes with practice and repetition. So by the time you get a strategy, also my advice is you can take out a few days or a trading week to try it out on your demo, and that is what we're going to get to do with this trading formula. And then to be able to make entry into the market at any time without regard to direction or trend and still exit the trade in net profit. Because the truth is, most often, the time, so I often used to have, I'm sure at the class, most of the classes you must have had that, most often when you're analyzing, 80% of the time you are waiting, you're trying to understand the trend and all of that. But with this winner trading formula, when we go into the practical part, you see that once you identify the first trend and you set up what we call a risk symmetry, you are able to now, without regard to whatever current direction, place trades that in both directions that will close simultaneously at a net profit for you. Vision and mission of this training. The vision is to achieve regular and consistent net profit from online financial trading. And then the mission of this course is to train online financial traders on how to help them make consistent profits in their everyday trading. Sounds good, right? Okay, let's look at some of the excitement and frustrations of currency trading. Now, the excitement and frustration of currency trading. So firstly, Thousands of traders sign up to trade currency daily with excitement. This is a basic truth. I wish it was, in a physical class, I usually try to get opinion from like 5 or so people. And you'll see that most often, if I ask you your trading journey or your trading history, most of us started with the excitement, either, oh, trading, this thing is something that I can hammer with. Most of the intention, and most times, even with friends around, the next thing, once someone just hear that, oh, you trade or you're into forex, the next thing they tell you, you be big boy. So there's always this excitement that traders start trading with. And most often than not, that excitement is often the factor that leads to the frustration. For instance, I know that maybe by show of hand, if anybody had this experience when you started trading and you started seeing profit, you had a list of the things you wanted to buy or the things you wanted to do with the profits from the trade. I'm sure most of us have that experience. So usually that excitement often sooner than later leads to frustration. Now, the same figure also abandoned trade daily out of frustration, because by the time the excitement is not being met, it soon leads to frustration. And then you are wondering, this thing, I was thinking that I should be able to make a whole lot of money from it. I should be thinking that I should be able to, by now, I should have bought a car, or by now, I should have changed my the location where I live and all of that. But you see, soon enough, by the time you are not achieving that steady, consistent profit, it leads to frustration. Now, the excitement gives way to frustration as a result of trade losses. Because come on, the reason for trading is to make profit. If you are not making profits, that means the aim is being defeated. Now, failures come from what? A negative impression about currency market. Now, I won't dwell so much on that because there are quite a lot of negative impression about trading the currency market, which I have mentioned some of them. The first is the impression that, oh, once I start this thing, I'm going to hammer, I'm going to change my house, change my car, change my fridge, and all of those things. Now, some of those failures come from that negative impression. So you find out that instead of trading, it blurs our analysis most of the time. So you see, instead of us making objective trading decisions, we are making those trading decisions based on the amount of money we want to make. So I want to do XYZ project. It costs 2 million. So I'm not, instead of me analyzing the market properly, I am looking for how I can make that 2 million naira in 1 week or in 1 month or whatever timeline we have set for ourselves. Basically, all of those things often causes turns excitement to frustration for a trader. What is the winner's trading formula system? Now, the WTF is a trading system designed to prevent trading losses and to help make consistent profit by symmetricizing the price charts with the Fibonacci numbers to create 2 symmetrical profit zones, both bullish and bearish profit zone. So you see why I said that there's also hedging as part of this trading formula. I told us at the beginning, we'll be looking at the Fibonacci concept, we'll be looking at the concept of hedging and also the concept of martingale. Now, basically, like this definition has it, the WTF just helps you to prevent loss by what? By giving you profit symmetries and 2 zones, both bullish and bearish zone. That means you can make both buy trades and sell trades and still eventually close them simultaneously at a profit. It prevents losses by continuously and increasingly taking long and short positions that are set up to close simultaneously in net profits in any of the 2 profit zones and restricts trade risks to the risk zone. Now, so basically, this second part here that I read is what I said. Most of us already do this. We have a long position, and the moment the long position is not going our way, out of fear, out of anxiety, we open a short position. Now, this is a similar concept here, but I'll be showing you the difference between what you were doing and what you should be doing based on this particular trading strategy. But let's look at some fundamental truths about the currency market before I get back to showing us what we should have been doing. The market can move in any direction within moments. That's one of the basic facts about currency market. And the truth is that is what helps us to profit. The fact that the market is constant, price is constantly moving. That's the reason why traders can take advantage of those price movements to make profits for themselves. Now, two, you don't need to know what will happen next before you succeed. Now, some people will say this is confusing because, I'm sure all through if you have attended all of the classes, our fundamental classes, our intermediate classes, you must have been told that, okay, you need to know where price is going to rise for you to make profits. Yes or yes. So you're supposed to watch your charts, study the trend, understand the direction for you to make profit. Now, with this trading formula, I'm going to show us that you don't necessarily need to know what will happen next before you succeed. There are numerous unknown forces acting in the market at every moment. This is another basic fact about the currency market. There are numerous forces that are causing price to change. I might just be here looking at my technicals, looking at my chart and all of that, and then there's one fundamental going on somewhere. Or suddenly there might just be, what's the name, earthquake in Japan, and the next thing is causing price to do otherwise. Or there might just be a news about a stock or a news in a certain economy. So there are numerous forces that are acting on the market at every moment. And the truth is, it is impossible for one human being or a few group of individuals to always know what those forces are or what those forces are up to, or what the market reaction of those forces will be on price. Now, number four, no matter the effort you put into market analysis, right, you cannot 100% predict the market. Yes, I'm sure this is another point that might be surprising to some people. And this is the basic truth. I also teach in my class that there's no 100% trader. What you only have good traders, and what makes a good trader is a trader that has more winning trades than losing trades. Take for instance, if I place 10 trades in a day, right? Some of those trades will not close in profit. But I can assure you that by the time I look at the net at the end of that trading day or that trading week or that trading month, it will net in profit, meaning the amount of winning trades will outnumber the amount of losing trades. So there's no 100%, no matter what your analysis, how sharp your analysis is, there's no 100% because it brings us back to number three. There are so many unknown forces that are acting on price. So I have done my technical analysis perfectly. I have seen all the support, the resistance, I have considered them when I place my trade. And suddenly, I'm sure those of us that are familiar with what's the name of this analysis site, investing.com, you must have seen underlying factors so many times. Those underlying factors just accounts for those numerous unknown forces that are acting on price, that are causing price to move in a direction different from where we have projected. So all of this makes number four valid, that you cannot 100% predict the market all of the time. Yes, you might have periods where in a whole day all of your trades close in profit, beautiful. In a whole week, all of your trades close in beautiful. Now, that would most especially be true for traders who place very few trades. But the truth, the more you trade, the more those chances reduces. Now, each moment in the market is unique. Yes, I'm sure we already come from the concept of price will always behave in similar patterns, right? Remember that there will still be uniqueness despite the similarity. So yes, price went up last week because of this, got to this resistance, came down, went back up. There will still be uniqueness in the way, either the rate at which it went up to that resistance or the rate at which it came back down to that support. There will always be this uniqueness. So you always treat, and that is why support and resistance cannot be one particular price level because of this unique factor. Because it's always a zone, because it might get to that exact price level. The next time it is coming back to test that resistance, it might not be at that exact price level. So each moment in the market comes with its own uniqueness. So introducing us to Fibonacci, just a bit of recap for those of us that came late. In the winner's trading formula, we're going to be looking at a bit of Fibonacci, a bit of hedging, and a bit of martingale. But let me introduce us to Fibonacci quickly. Now, remember, this class today is more of an introductory session. So we will not dwell heavily on Fibonacci. I'll just give us a bit of background. For those of us that have traded before, we might already know a bit of Fibonacci. Some of us might not have known. But either way, the little introduction I'll do right now should cover for it. So introduction to Fibonacci, right? Fibonacci, to put it basically, is a series of numbers. Now, back in 1157, there was this Italian mathematician, right, that came up with the Fibonacci concept. And basically, you know, for Italians at that age, they were using basically Roman figures. And he said on one of his trips, he encountered an Arabic mathematician and noticed that the figures they used to represent numbers was different from what they used in Europe. And he decided to adopt those numbers and then studied further into the numbers, and that was how he came up with the popular Fibonacci sequence and all of that, right? So famous Italian mathematician Leonardo Fibonacci, who identified the Fibonacci series. Now, basically, the basic thing with this Fibonacci series, he was able to, through his research, he said that almost everything in life, you can relate it to these Fibonacci numbers. So this Fibonacci sequence applies to almost every sphere in life. And the truth is, currently, there's hardly a sphere of life that has not, Fibonacci has not been inculcated into. But basically, right, you can see these numbers in red. Those are Fibonacci numbers. So the basic concept is that you can use the present. So if you see these numbers in red, 0, 1, 1, 2, 3, you can use, it's from a concept that you can use the present, you can use the past, right, which is 0, and the present to tell what the future can give. Let me take you back a bit. You can use, if you have information about the past, and then you have information about the present, it helps you to make future predictions. It gives you an insight to what tomorrow can be. So basically, and that's why you have this number sequence, right? 0 and 1 will give you 1. So if you put 1, which becomes the immediate past, right, and the present 1, it gives you 2. So same thing, if you take 1 as the past, 2 as the present, it gives you 3. If you take 3 as the if you take 2 as the past, 3 as the present, it gives you 5, and then and so on going. So basically, that is the sequence for the Fibonacci number. And then it now gives you a ratio. Now that ratio basically is, if you put the sum of the two previous numbers, it should give you a ratio that is around this 1.61. And that is why you see that the 61 Fibonacci level has been chosen as the golden ratio. So basically, the golden ratio is just the ratio of all of this. If you put these numbers by the way they follow each other, and you do the ratio, it gives you a ratio around 1.61, right? Either approximately or exactly it. Once you do all of those sequencing, you'll get that. Now, a series, the Fibonacci explained, a series of numbers which many assert relates to natural universal proportion. Now, so it is said that if you look at both the way petals form on a flower, if you look at the way branches are arranged, even right to DNA structure. I was recently taking a course on project management, and I realized that the Fibonacci sequence popped up there again. It is being used even in construction, not just in mathematics alone. So that's why Fibonacci number is said to apply to every sphere in life. And the truth is, the way researches work is that once a research is done in a particular area, so for instance, let's say a mathematician has done a research. Now, the economists will want to look at it, okay, if this thing has successfully worked in this field, let's borrow this concept and bring it to our field. Is it going to work? And if it works, the next thing, the medical people will say, okay, let's pick this concept, let's try it. And then that's how over time, people from fields outside the mathematical fields were able to adopt the Fibonacci sequence series to apply it to almost every sphere in life, right? So basically, if you look at, this is what the pattern forms. So from 1, 1, 2, if you look at this shape here, it's giving you a formation that coincides with the Fibonacci sequence. And then it is said that even in beauty, in art, so there is this saying that the proportion of your nose to your eyes to your ears, that once, as the closer they are to a Fibonacci sequence, the more beautiful you'll be. You look at it, even in music, if you look at your keyboard here, that concept has also been inculcated there. If you look at the way a baby is formed, in, like I told us, in construction, it is used, in music, in various, every field has adopted that. So hence the reason why we find it in trading. I'm just giving all this background to let us understand that, yes, it's a mathematical concept, and the truth is, even trading has quite a number of mathematics in it, right? And then we look at, we have what we call the retracement level. So adopting it to trading now. So we are not just looking at the number series. We just want to look at 0, 1, 1, 2, 3, 5, 8, and the rest. No, we want to bring it down to how it matters to us in trading. So in trading, basically, we often, the most thing we look at is often the retracement level. But suppose I've gotten so familiar to our MT4, you realize that there's the expansion and then the retracement level. But most often what we use is the retracement level, right? So the Fibonacci retracement level, the major retracement level we have at the 38.2, the 50% level, because that's the midway, right? We have 0 to 100, 50 is midway. And then the 81, the 61.8, which is the golden ratio. You have other minor levels, but most often we focus on the golden, focus on the major ones. Now, the reason why we have this retracement level, why we pay attention to this retracement level, is because price will always retrace, yes or yes. Every time if price is going on an uptrend, Euro USD will not just pick one direction from, if not, everybody will just be on that. So it will always, price will always fluctuate. Price will be on one trend, later on pull back, retrace, reverse, and all of those things. So because of all of those things, that is what traders use the Fibonacci retracement levels basically for. So if price is pulling back, at what point this pullback, what point will it get to before it continues in another trend, continue its initial trend, or what point will it get to that I know that no, this is no longer a pullback, it is a reversal for me to join the opposite trend. So basically, that is what your Fibonacci tool does for you. Now, like I said, I will not go too much on showing us everything about Fibonacci. The truth is, you cannot get everything about Fibonacci in one class. For those of us that have been following Rising academic classes, you might have come across that class at one point or the other. If not, I'm sure before the month goes out, we would have had some other classes of Fibonacci. And also because this class, this is just the first part of this trading formula. Now, we're going to have the main class of this next week. So by the time we're having that class, we might give a bit more time to join Fibonacci and all of that. Or better still, you can go online either from the Raleigh Academy or request from your account manager if there are videos from past Fibonacci classes that you can practice on before the main class next week. That's for those of us that don't already know, understand how to use the Fibonacci by now. So basically, like I was saying, right, we have our retracement levels and then we have our extension levels. So basically, I want to know, okay, what point, the points that price will retrace to. And then after that retracement, if it extends, that I will now have a need to draw a Fibonacci extension to know that, okay, if price has broken these levels, these retracement levels, where is it going to continue to? So you can see from the 23.6, 38.2, these are the retracement levels, right? Remember, I told us the major ones are 38.2, 50%, and the 61.8. So if price is breaking beyond this, where next is it going to? And most often, that is where the Fibonacci extension or expansion comes into play. When I switch to my main charts, I'll just show us quickly where to pick the tool from and how to draw it on our charts to see all of these levels I'm referring to. So basically now, if we look at, it's just a screenshot of a chart, right? If we look at a 1 year recovery, is Euro USD. So basically, right, price was going up here. So price started an upward trend. But we all know that in between that upward trend, there will be some pullback, there will be some retracement and the rest. And then the moment price got to this level, the moment price got here, can you see my, okay, there's all this. Now, the moment price got here, you can see that price started going down. There was a retracement here. But you want to know at what point will this retracement, at what point should I expect this retracement to stop for me to join in another buy? Because the truth is, okay, some of us trading basic technicals, right, might have gotten to this significant point of resistance and then picked a sell. But if I have done my extension, if I look at, so let me go. So if I've imputed my Fibonacci, for instance, so I am here, I'm wondering, okay, price is about to pull up. I want to understand this pull up that price is doing here, this pullback that price has here. At what point will it get to for it to go back down? So that if I am picking a buy here, what it does, what your Fibonacci also helps you to do is that it tells you, okay, I have picked a buy here, right? At what point should I exit that buy? Or I have not joined a buy. At what point should I expect that buy would weaken for the sell to continue? So basically, price is going up here. What do I expect next? And then if I pick my Fibonacci tool, right, and I plot it on this, I put my Fibonacci here, right, and I can see my level. So you can see this is 0%, 0 to 100. So remember, your Fibonacci ratios is between your 0 to 100, right? And then remember, our major point is the 38.2 and our 50% and our 61.8. And then you have your two minor levels. You can see that price started off to 32. But eventually, you can see that price got to 38. So for instance, when I was still here, my expectation is that price should get to 38. Yes, further analysis would have revealed that, okay, fine, this trend is already reversing from an uptrend to a downtrend. But I want to know this pullback here, at what point should I get a better entry? What should signal me, give me a sign that there's a rejection from this pullback for me to continue in a downtrend? And then you look at it. So for me, I want to use my 38.2 Fibonacci level, because remember, it is a major Fibonacci level. Now, once price gets there, you see, this becomes a safe point for me to enter my sell trade. And then my 0% becomes my take profit. Now, remember, like I said, it doesn't have to be the exact price level. My take profit can be before that level, but this level is telling me that at this point, price might extend, which is where our Fibonacci extension comes in. It might extend, it might not extend. But Fibonacci retracement has given me the first information that I need. Are we still together? So Fibonacci projections, however, which is the projection that is the same thing as the extension, now having recovered 38% and started to trend downwards again, Fibonacci projection can be used to determine potential price objectives, which was what I was saying here. It has gotten to 38, it has come back down. Now, the extension will tell me where next to target on the chart, right? So price has extended from this point and is it going to come down here or not? And then I put in my extension. Now remember, 61% is a significant price level in the extension, right? Once I make my sell trade here and I come here, I am looking at taking my profit here. Now, but remember, in this class, we're not looking at how to just look at, so we're not looking at this Fibonacci now to just pick trades. I'm just giving us a background as to how Fibonacci works. So in the winners trading formula, I don't have to be looking at all of these Fibonacci levels individually. I just need to be able to identify my area of risk. And then anything above my area of risk is my profiting zone. Anything below my area of risk is my profiting zone for a sell trade. And anything above my risk area is my profiting zone for a buy trade. Now, but to conclude on Fibonacci, right? So basically, we have our Fibonacci retracement numbers here, and then the extension numbers here are the ones in red. So you can see the ones in red are in negative because they are extended from the main Fibonacci retracement level. So basically, your Fibonacci gives you a pattern like this. Let me see, at this point, I should go to my, let me just exit just a moment. Let me stop sharing this and go to my chart so that we can see a bit of where to pick the Fibonacci from, because I'm done with the Fibonacci from here. Okay, so I need to reshare this one. Okay, so we can all see my screen, right? Now, just a little on how to pick this Fibonacci for those of us that have not really used the Fibonacci tool before. Remember, I said in this class, we're not dwelling on how to use Fibonacci in depth. And the good thing now, one of the reasons why Fibonacci is one of my favorite tools to use is because it is also available on the mobile. And then also, you can use it to identify your support and resistance level. So for instance, anytime I am on my mobile, on the mobile, you cannot import indicators like you can do with the laptop. So it gives you a good advantage to be able to draw up your Fibonacci line and then use those. So you can use, you see those major points I told us, the 38, the 61, you can use those points as your major area of support and resistance when using the mobile, and you cannot insert indicators for this. So that's one of the reasons why I really like the Fibonacci. So basically, if we pick, let me try to pick a plain chart. Okay. So if, for instance, I pick this chart, right, and I want to have my Fibonacci there, can we all see my screen? Can we see my cursor on the screen, right? If I come, let me make it a plain chart so that it's looking like what most of us are used to. It's green and red. Okay, fine. I have a green and red. So if I put this on a 4-hour time frame, so I can decide, okay, so I can see clearly that there was an uptrend. Now, this uptrend is weakening. Why? This AUD USD 4 hours time frame. Because this area is an area of resistance. You can see that 3 times price got around here, it was pushed back down. So for instance, I want to see the extent of this retracement. I just come here. You can see where you have this F sign here, right? This is for those of us that are using, trying to use Fibonacci for the first time. You can just go there, click on it. So now, because it was an uptrend, right? When I want to see retracements, I'm going to draw it from bottom up. Now, remember, this is not a class where you perfect Fibonacci, but just to show us how it works. So I pull this from here, and then I drop it to this point. So basically, if you can see from the sides, right, you'll be able to see those Fibonacci sequence. Now, my own is a bit, mine will look a bit different because I have done some adjustment to it to already suit my linear trading formula. So that's why you see some other figures on it. You notice that from this point where I have 100, you can see that I have my 62, which is your 61 8 level. I have my 38 here. I have my 24, which is minor. So I have all of those levels. So by the time price goes to 0 and it's pulling back, I expect that the next stop. So let me take it. Let me take it a smaller time frame so that we'll do something more immediate. So I just brought it on a smaller time frame, so we can just see something more immediate. Now you can see that coming from last week, it was an uptrend, right? And then here, this is Monday, Tuesday, today is Wednesday. Now I picked the lowest point. Since it was an uptrend, I picked the recent lowest point, and the highest point is created this week. Now you can notice that this gives me 100, 0 to 100 here. You can see that when price got rejected here, you can see that that retracement got to 38. And stopped at 38. Now it got to 50. Remember, we have 38, we have 50, and then we have 61. You can see that by the time it got to 50, it pulled back up. Now, my expectation is that once it breaks below this 50, the next stop I'm expecting is the 61.8 level. Now, at this level, so for instance, if I join a cell now, I am looking at my exiting points around here. Except price breaks low, if I'm taking my profit here, I am waiting to see will price extend or not. I remember, so for me, I have incorporated my Fibonacci, both the retracement and the extension, because I use it majorly to trade my winners trading formula. So I have both here, which I'm going to show you how to do that in the class, so that you don't have to draw your Fibonacci retracement separately and then start drawing your extension separately. You merge two of them together, and then they will also give you the exact price level. So if I'm looking at setting a pending order, for instance, it gives me. Another is breaking. Okay, sorry about that. Probably from the network. Let me see which internet, if I can switch internet. I'm using the strongest one already. Okay, please bear with me. I think it's just the regular internet challenges we have. I'll try to switch internet so that you can have better audio. So like I was saying, I said, so basically, remember I said, this is not a class where we'll do so much of Fibonacci. I'm just showing you that how it relates to this trading strategy. So that is why, for those of us already familiar with Fibonacci, you notice that mine looks slightly different because I have incorporated both the retracement and the expansion together, so that I don't have to draw them separately. Because for me, that would require more effort. I just often like work to be simpler. So instead of drawing them separately, I have two of them matched together. So I know that once it exits 100, I know the next point I'm looking at, right? Now let me leave this here. When we come to figuring an area of symmetry, we'll come back to look at this chart we have drawn here in picking our trades. Let's go back to the slide. Okay, we're back to the chart now, right? So now, what is the winners trading system? The winners trading system is designed to prevent losses and make consistent profit by symmetricizing the price chart with the Fibonacci numbers. So it gives you, symmetry is something that is similar, right? It gives you a similar price level, because the reason why I am drawing Fibonacci and I'm looking, like I said, is so that I will know when to enter and when to exit the trade. It's not because I want to be a guru mathematician or I want to be the best at drawing it. No, I want to understand what price level. So I want to see if it coincides with the major, every level that coincides with the major retracement level or the major Fibonacci level, it gives me an information. It tells me, okay, at this point, if I am in a trade already, I know that, okay, I'm taking profit at those major points, or I'm targeting those major points as rejection points for me to enter another trade. So basically, and the winners trading formula helps you to do that with the help of the Fibonacci. That's why we have married the Fibonacci into the trading system. Now, losses and make consistent profit by symmetricizing the Fibonacci numbers to create two symmetrical profit zones. So like we said earlier on in our, when we're looking at our goals, and so we said you'll be able to place both long and short trades, and then also be able to close them simultaneously and still net in profit. It prevents losses by continuously and increasingly taking long and short positions that are set up to close simultaneously at net profit in any of the two profit zones and restricts risk in that zone. So let's look at this, for instance. So if I have drawn my trade, right, I have drawn my Fibonacci, and then I have a major level of 638.62. So basically, I use this information to give me the midpoint. You see this midpoint I have here becomes my area of risk. So I know that what I am doing is I'm just waiting anytime price trades outside this channel, it becomes an opportunity for me to buy or sell. It's not like when you have market ranging, right? When you have price ranging in the channel, you are always looking out for a breakout. Is that not? So drawing this Fibonacci symmetry, right, gives you creates that channel for you. so that you are not just looking at your charts, right, and assuming the channel and looking at, okay, this is where I expect price to break out from. This Fibonacci sequence gives you already the channel you are looking out for price to trade. So everything between B and C, everything within this 38% level becomes sort of your channel where price is ranging. So what you are targeting is for price to go above C for you to pick a buy trade, or for price to go below B for you to pick a sell trade. Are we still together? Now let me repeat that again. Remember, we just came from showing you Fibonacci, right? And I'm trying to relate the reason for drawing that Fibonacci is to create a symmetry. And that symmetry becomes your area of risk. So that area of risk, you don't trade when price is in the area of risk. And that is why I likened it to when price is trading. So you are waiting for, when price is ranging, rather, you are waiting for price to break out of that range or out of that channel, either break up for you to place a buy trade or break downwards for you to join a sell trade, right? Now, with this trading formula, when you draw up your Fibonacci, right, you are expecting this midpoint becomes your area of risk. So you are not placing trade when price is still in this axis of symmetry or your risk zone. You are waiting for price. So between B and C, in between here is a no trade zone. You want price to break towards C, go above C for you to enter a buy trade, or price to break below B for you to enter a sell trade. Now, once I set this up, it also works with pending order, because I don't want to be glued. One of the traders in the Abuja office will say monetary spirit. I don't want to, because I am a trader, become a monetary spirit. So all I'm doing is sitting down on my charts, because the truth is, remember, when looking at one of the typical characteristics of price is that price behaves uniquely. Price is constantly moving. You don't know if it will take 5 minutes, 10 minutes, or it will take a whole day for price to go upwards or downwards. Sometimes price can trade a whole day within a channel. So you can imagine you are there just looking at it. So now, it also works with pending orders. So once I have identified my area of symmetry, I have a buy stop above and I have a sell stop below, so that I'm free of the money trade. Now, once price breaks above, it picks a buy trade. You see this D here becomes your take profit zone. Now, this take profit zone, you notice that, so I have, the chart has been divided equally, right? The profit zone is 62%, it's within 62%. The sell zone is also within 62%. When price breaks above here and it picks a buy trade for me, this becomes my take profit level. The moment I am setting my trade, I am setting those take profit. The moment I'm setting my pending order, I am setting those trade levels. You can see it has picked the price level here. So you can either use your horizontal line to pick the price level, or using my method, which I will show us in the class later on, I have set my Fibonacci such that it gives me the price level for a particular percentage zone. So I don't need to be looking for price level independently. Again, remember I told you I like simpler ways to do things. So if this has picked a buy trade for me, and then the price goes. Now, but you know, very typical of price, I think it's here on the next chart. Where do I have chart? Okay, I have that. Now, very typical of price zone, right? Of price. You know that, is it every time that you pick a buy trade, that price just goes straight to your take profit? There's no sound. Okay, there's sound, right? Okay, wait. Now, it is not every time that you pick, because you have entered the buy, that does not automatically mean that the market will now continue to go up until it hits your take profit. Or because you have entered sell, price will just automatically go down to hit your stop loss. So price can behave otherwise. You know, sometimes price will pick your pending order and then goes halfway, or even get close to your take profit and start to go down. Now, in this trading formula, you are not supposed to panic, because if price should come down and wants to go out of beneath the risk zone, it will pick your sell stop or your sell order here. It will pick another pending order here, which means that you will now have what? Buy and sell. Now, yes, I'm sure some people are wondering now, okay, I have buy and sell. How do I now make profit from it? Now, in the winner's trading formula, right, the difference is that the lot sizing is going to be different. That is the difference between what you have been doing and what you should be doing with the winner's trading formula. So if, for instance, I have a 0 point for ease of calculation, let's say I have one lot size here, right? It has picked a buy one lot size. When price comes down to pick my sell, I am not setting one lot size again. I am using 2 lot size. I am doubling the lot size. Now, the reason is that so that as the sell trade, so for instance, price didn't go to my buy trade, didn't go to my take profit, one standard lot, right? And then it starts to come down. You know, already I am losing. If it goes below my entry point, I am in complete loss. If it comes down and it picks my sell trade, now if my sell trade is the same one standard lot, I am still at no profit because at best, let's say if I was at minus $50, I will still remain at minus $50 because the more the profit is increasing, the loss will be increasing also. So at net, I will be at a negative. But the good thing with the winner's trading formula is that the sell is expected to pick at a higher lot size. So if it has picked one lot size here, by the time it comes down to pick the sell trade, it will be 2 lots. It will be at 2 lots. Now that means it will quickly outweigh the negative from the buy. Because soon enough, it will be at break even, and then it will start to get into profit. So what happens is that by the time, if the sell trade now becomes the one that hits 6 profits, do you think I will still be at a loss? Absolutely not. I'll be at a profit. Because the lot size on the winning trade is more than the lot size, the volume on the losing trade. So that simultaneously, and by the time I take my, what's the name? My pending order picks for the sell trade, right? I quickly adjust as I am setting my take profit at this level. I am also setting the stop loss for the buy trade at that level. Are we together? It picks a buy trade, it doesn't go into profit, it comes into loss, it picks a sell trade. I take the stop loss from the buy trade, right, from the losing trade. I put it at the same level. I put it as almost the same level with the take profit of the winning trade, which is the sell trade. That is the reason why when the trade closes, it will close simultaneously. Both the buy and the sell will close together. But because the winning trade, which is the sell trade, is at a bigger lot size, it will outweigh the loss on the losing trade. It will want to outweigh that of the losing trade. So simultaneously, I will be in profit. So that's the difference. So that's what I said. That's the difference between the hedging you have been doing, just praising the same lot size and wondering when you will exit, when is the best time for you to exit, and you are scared, okay, no, if the sell is in profit now, if I close the sell, the negative on the buy will be increasing. How do I go about it? So basically, that is the difference, and that's what we seek to achieve with this winner trading formula. So let's look at this chart, for instance, right? We have a chart on Euro USD. So if we're using points A and B here, so we can see it's an uptrend. So let's say we're trying, because the first thing you want to do is try to find your area of symmetry. That's the first thing. You want to identify your risks. And the truth is, you can only manage a risk that you can preempt ahead. If you can preempt your risks ahead, you cannot manage it. So when using this formula, the first thing is when I look at my charts, I want to first of all identify that area of symmetry, which is the area of risk. Because the truth is, your area of risk determines your worst case scenario. So you're thinking that, okay, this is the worst case scenario, right? So I pick my Fibonacci and I draw between point A, which is the lowest point, to point B, which is the highest point. Now, in between midpoints, point A and point B, you can see this is my AX here, AX here. Between here becomes the channel, my risk channel. the area where I expect that price will break above or beneath for me to pick a buy or a sell trade. Point 1 up here becomes my take profit target for my buy trade. Point 2 here becomes my take profit target for my sell trade. You can see this is our axis of symmetry, which is same thing as our axis of risk, right? Now, and then, basically, like I was saying earlier on, every time you enter a trade and immediately you get into profit. The truth is, the first scenario I gave us was price came to go up and immediately went down, right? And then it goes into profit. Now, not all of the time price will behave like that. So for instance, if you look at this image I have here, right? First thing I did was to identify my area of risk, which is my risk zone. Above it is my buy order, below it is my sell order. So if we start from this point, notice that when price came up here, right, you would have picked a buy trade. Take profit was at this bullish profit target. You can see that it's not price, because we know that most times my experience, my notion with price is that sometimes price is always very stubborn. And I'm sure most of us would have had that feeling, like it was when I entered buy that market started selling, or it was the moment I entered sell that market started buying. Now some of us would be quick to say, no, they are haunting me. Nobody is haunting you. That's the truth. But now you can decide, and that's the reason why pro traders often try to formulate trading strategies, because those strategies are a way of beating those kind of occurrence or those kind of situations. So if price has gone up, price is going up, I have picked a buy trade, and then price wants to start going down, no problem. I have a strategy to mitigate against that. The moment price starts coming down, here I would have still been in profit. By the time price crosses this line, which is my entry point, I am at a loss. So all I do is I don't panic. And then please, there's also something I have observed with traders that I often beg traders to do. If you are using a particular strategy, please always stick to the rules of that strategy 100%. If I want to trade today or this week, and I know that I am using XYZ trading strategy, make sure you stick to it. Now, there's a reason why I'm emphasizing on this. Later on, we'll get to it. Now, if I have picked a buy trade, right, by the time price comes below the entry point, I am at negative. And I'm not worried, because I know that this area of risk, right, will most likely push price back up. But just in case price is stubborn and price refuses to go back up, no problem. I have a pending order for sell for it here. If it comes down here and it picks a sell trade, now remember, this sell will be at a higher lot size. You can see that price refuses to go down. Price would have initiated my pending order and has started going up. Now, by the time price is going up, at this midpoint, both my buy and my sell will be at a negative. And then normal trader will want to panic. But for me, I am not panicking. Why? Because I have a trading formula that I have used over time, I have backtested, and it's working. So I just wait for price to behave the way it wants to behave. And most likely, sometimes price will range within this channel and still come down. If it comes down, beautiful, it will hit your target. If it doesn't come down and it's going back up, right? Wisdom, I can see you raised your hand. I don't know if it's for a question, but let me just finish explaining this. Hopefully your answer is in this, and then I can take your question. So if price fails to go down and is going up, now that's this second time that price is getting here. The moment price gets here, I will have another pending order here for a buy. Yes, the trading system, remember I told you, martingale is a trading system that opens what? Multiple trades at the same time. So by the time price is coming back up here, I'm not just watching, because remember that if price should go up, I will be at a disadvantage, because it means that my sell trade will be at a bigger volume than the buy trade. So it's not good for me. When it was coming down, it's good for me because the trade volume for the sell is bigger than the buy. So I'm safe. But by the time it goes back up, it is not safe for me to allow that the buy trade to have less volume. So I'll enter a bigger lot size here. So just for ease of math, please, because I know that our account size balance, just for ease of calculation, that's why I'm using standard lots, right? I've entered standard lot 1 here, I've entered 2 here. By the time it's coming back up, I'm entering 3. I'm making it 3. Why? Because the total volume for the buy trade should outweigh the one for the sell. So I have, that will make my total volume for the buy trade what? 1 and then 3. That will make it 4. Meanwhile, the sell trade has volume of 2, which is double of it. Please, do you think that by the time this buy trade is in profit, am I still going to be at loss? Net. So you notice that by the time I will definitely be in profit because the volume outnumbers it. Now, the one first scenario is that price will just go from this point and then just hit my take profit. So that way I will have 2 standard lots of sell that is negative, and then I will have 4 standard lots in buy that is in profit, which means that net I am in profit of 2 pips. So whatever 2 pips amounts to, let's say for instance, I am trading at $10 per pips, right? And then let's assume that the distance between here and here is say 50 pips. At $10 per pips for a standard lot, you're having 50 pips, that's $500. So if I had 4 lots, that would be, if I had 4 lots, that would be like $4,000 if my math is, no, that would be $2,000 if my math is right. But at 2 pips, that would be $1,000. So that means I'll have minus $1,000 on the sell trade, and I'll have a profit of $2,000 on the buy trade. Please, by the time you do a net of minus 1,000 and profit of 2,000, it still gives you a profit of 1,000. So you see the difference now with what we're doing. But if for some reasons, because yes, it is possible that price will not still go and hit your target profit. Price will decide to come down, right, without taking your profit. If price comes down here and goes towards the sell, there's another sell pending order at a higher lot size than this last buy, waiting for it here. You can see that in this scenario, price refused to go completely down, so that it went back up. At this point that it's coming back up here again, there is another sell waiting, there's another buy waiting for it there. Eventually, when price went, it came back down again. Now, I have seen a situation where traders just got tired. Okay, it's already in profit now. I've made $500. I close it. Beautiful. But do you know that even when you leave that trade, you can still get into profit? Because by the time it comes back down, there's another sell. So basically, the aim is to have a cumulative lot size, because at this point, the lot size on this winning trade will definitely be more than the lot size of the losing trade. And then remember that as I am setting as my trade order is speaking, I am setting both take profit and stop loss simultaneously. It's not after it has closed profits, I'll be struggling to close loss. No, I'm setting there, you know, and here I say that a trade system where your trades will close simultaneously and still net you in profit. So by the time it comes back to its final destination, where price have decided to behave normal and choose one direction to go to, by then I will have more trading volume at that direction. And then eventually when it comes to this take profit targets, both my take profit and then this stop loss for the buy trades are all around there. By the time it closes me out, I am definitely netting profits. So that is the basic concept of the hedging system we use for the winners trading formula. So we're not just hedging, placing buy and sell simultaneously at the same time and just wondering, oh God, when should I close the buy? When should I close the sell? No. And then also, no. The reasoning behind this concept, the theoretical reasoning behind this concept is the binary trial probability theory. Now, according to this theory, right, independent and repeated trial of experiments within exactly 2 possible outcomes, success and failure, have equal probability of occurrence. It's like trading, price will either go up or down. That means there are equal chances that both will happen. If you do head and tail, there are equal chances that both will happen. But by the time you increase in one direction, there's more likely, okay, you have equal occurrence, right? Provided that the subject coin of the trial is fair. In other words, the probability of success and failure is 50% for both outcomes. The sum of the 2 outcomes is equal to 1. And that's why if you keep placing the same lot size, buy and sell, the outcome will be the same. The negative will just be there unchanged. The outcome of currency trading is profit, right? Success or loss. Though continually increasing the number, so through continually increasing the number of the lot size in long and short position, according to the trend I've just shown us, right, modifies the fairness. So, in the first situation, I will just keep putting the same lot size. One lot buy, one lot sell. To keep my outcome at the same. But with this trading formula now, we are doing what? We are modifying the fairness. You are not being completely fair now. You are modifying the fairness by doing what? By increasing the lot size on the other side. That is now what makes you close out at net profit. With this bias, there is always what? A certainty of profit and target. So long as you don't make the lot size the same, you always do what? You will always net out at profit. Why? Because the winning trade will be what? We have more volume than the losing trade. Now, the law of large numbers also, to the law of large numbers, right? By performing the same experiment many times, the result obtained should be close to the mean or expected outcome. Therefore, by increasing the number of opposite orders in currency trading, the result tends to the expected target. So you are not just doing a fair trial here. You have some certain bias in the direction that it is going to by increasing the lot size to so that you can sort of manipulate the outcome to your favor. Now, backtesting this result, this WTS, right? We had 11 major currency pairs we used to treat within 3 months. So within 3 months, we took 11 currency pairs. And then on a 1 hour time frame, the results showed that a total of 349 trades were picked. So within that 3 months, on 11 instruments, the total number of trades, buy, sell, that were picked were 349. Out of those 349 trades, 86 of them, which represent 24%, hit targets with one open position. Let me take this again. We had a total of 349 trades. Only about 24% entered take profit at the first position. So it picked buy and just went straight and hit it buy take profit. Now, the interpretation of this is that, in your normal trading, right? I'm sure coming from the class, what you have thought is you set your trade. So I put a buy trade, I put take profit, I put stop loss. Is that not? So that means 86 trade would have taken profit, which is 24%. Can you imagine what would have happened to the other 50 about 75%? That means those 75% would have hit stop loss. Did we get to that point? I'm just trying to show us the difference between using this formula and the regular trading formula you have been using. If I use my regular trading formula, I place buy, I place take profit, I place stop loss 349 times, right? Only 86 took profit. I know if your trade does not take profit, that means those ones that do not take profit, that means they will take loss. So it means that using your normal trading formula, you are going to lose what? About 75% of your trade. You see why you will most likely be having more losing trades than winning trades. These are winning trades that move to hit the setup target as planned with a single position. This means that 75.36% had more than one position. So it also means, but with the winning trading formula, right, it means that those other trades had multiple positions, which was what? Let me show us here. It meant that with that research, right, 86, which is 24%, the moment they picked one position, they hit take profit. But it means that about 75% of it had to take multiple positions. So yes, sometimes your first trade that it picks, it will hit profits, glory to God, that's a good trading day. But some other times it will have to what? Enter into multiple positions. So you having 2 trades, you having 3 trades, 4 trades, and all of that, right? This implies that more than 75% of your setup would have hit stop loss. That is irregular trading. I've explained this already. The conclusion is that most traders will fail as a result of poor winning ratio. Because you can see the winning ratio here is just 24 to 75. And I can bet most of us can relate to this. Even just from using our demo, because most times from the class, I have clients make that complaint that, no, I'm having more losing trades. Most of the time, my trades are hitting stop loss than hitting take profit and all of that, because it is the regular system of trading. But this is the problem. That's the particular problem that was identified by Bradley Academy in collaboration with Mr. Oroke to bring about this winner's trading formula. It is aimed at solving that particular problem. So now, just an interpretation, let me show us a chart analysis of these 349 trades that were tested. So you can see that these are all the currency pairs that were tested, 11 of them, Euro USD, GBP USD. You can see they are all majors. And I'm sure there's nobody here that will not relate to either 2 or 3 of any of these currency pairs here, because they are the major currency pairs. Now you see that this is a summary of the backtesting, right? Only 3 of these 11 pairs, only 3 of them had opened more than 6 positions before the target was hit. Because I know that for most of us, the worry will be that, this one that I'm opening multiple trades with higher lot size. What is my account balance? Will this not be trouble? And you know, that means that the more number of trades it has to open, it means that the more margin you require. Excuse me. It also means that the more trading capital you also require. But based on this our trial, only 3 trades, only 3 instruments, which is GBP USD, GBP CHF, and then GBP JPY. The last time in my class, one client said that thank God he doesn't trade anything GBP. But this was just based on our trial. On some other days, it could be any other currency pair, right? And then if you look at this number here, right? It said number of open positions before hitting target. So remember, total trades, I told you about 11 trades, our 11 instruments open was 349. So here you have Euro USD open 29 trades. Of those 29 trades, 7 of them from the first trade it picked. Let's say initially the first trade after setting up our area of symmetry and all of that. After setting up our area of symmetry and all of that, let's say the first trade it picked was a buy trade. It means that 7 of those 29 trades just went straight to hit take profit. And then 6 of those 29 trades had to pick a second trade. That means after picking the initial buy, he had to come back, pick sell. It was now the sell that took profit and closed the buy at a loss. Another 6 of them, of the 29 trades, had to open the third trade. Another 5 had to open 4 trades, 5 trades, 6 trades. But you can see that the worst case scenario was 6 trades. And then you see that by even the 6th trade, you have fewer trades getting to open that much. So you can see, even if you look at from the total here, you have fewer trades opening, fewer scenario where you had the trades open up to as much as 5, 6 trades. So same thing. So it's the same thing. By the time you pick GBP USD, you see the same thing. 31 trades in total. 8 of them hit profit from the first choice direction of trade. Another 9 had to pick 2, 7 had to pick 3, and so on. So it's that in the case of Euro USD, 1 trade got to the 7th on 1 occasion. The trade had to get picked 7 times before it hits target. And then you can see that on GBP CHF, same thing. On GBP CHF, there was 1 scenario where it got to 7 trades. There was another scenario where it got to 8 trades. Now, the reason I'm showing us this, it means that this could be a lot of volume. This is a lot of volume on your lot size. So now, but next thing I will show us how you can portion that, because you can decide based on your account size, you can decide to do most likely start with maybe 0.01. So by the time you are doing a double incremental, the next trade will be 0.02. If your account size is big, fine, you can start with 0.1, or you can start with a standard lot. But it's just giving you the worst possible scenario. And remember, like I said, the worst possible scenario determines your risk. So if I know that the worst possible scenario in this trade is that it will get to minus, let's say it will get to minus 500,000, and I have an account with 5 million, I will not be bothered because I already know. So I have analyzed my risks ahead and I know that this is the worst possible scenario. So this is sort of what this table is showing us. And then remember, of course, most of us will only have maybe 2 favorite instruments of all of this at a time. And the truth is, it will be weird if you have more than that number of favorite instruments. Because it's my advice, though, you might agree with it, you might not agree with it, but it is often easier when you have fewer favorite instruments. It gives you better knowledge on it. You have more time to be able to research on them and have better understanding on them than when you have so many of them. Because when you have so many of them, today you are running, you are trying to understand what's happening with JPY, what's happening in CHF, what's happening to stocks, what's happening to this. So if you're able to, at least for starters, build your background knowledge on a few favorite instruments, and then over time you can now understand their similarities and then now know, okay, fine, Euro USD is similar to GBP USD, okay, so I can add USD and all of those things. But back to our winners trading formula. So beyond 60 positions, right? That's beyond 6 trades. 5 out of those 349 swing trades tested. So, and that when you bring it to percentage, it's significantly low. Just about 1.5% of the time that we had those off situation. Now, these are multiple positioning positions with increasing volume, right? To increase multiple positions with increasing net profit. So, for instance, every trade. So, let's say this is just giving you an instance of those trades. Remember, you're opening both buy and sell. So, if you look at our start position here, it's either a long trade or a short trade, which means either a buy trade or a sell trade. Now, if the first trade was picked at one lot size, right? You can see that by the next time you are picking, so if it fails to go up and it's coming back down, your second position will be what? Should be a sell trade, because the first position was a long trade. So it's not that when it's trying to come down, it pulls back a bit, you enter another buy. No, you wait for it. Remember that you are setting, it's almost like setting trap for price. You have your area of, remember, you first start by identifying your area of symmetry. And then you put those trade order around those levels. So it has picked my buy order. It fails to go up. As it is coming down, I have a sell order. Once it crosses that level, it picks my sell order. So that makes the second position, which becomes 2 lots, right? You can see that the increment is doubled going down. Now, the truth is, remember I said this is just for an instance, because I doubt any of us here will be able to open as much as 32 lot size or 64 lot size and still be okay. I'm sure at that point, our temperature would have busted the thermometer. This is just for ease of calculation. So like I said, you can start up, there's a table to calculate risks. I think it's after this one. You can start up with your micro lot size, right? So I think that's what should be next. So now, this table now is very key. Now, not to worry, because I'm sure some of us are already looking at, this table, you don't have to plot it. This table is part of the learning materials we are going to give to you. We are going to make accessible to you. So you are not calculating these risks from your head. You are not having to go and do your own table on Excel or anything by yourself. We are going to provide you with this table. And you can see it's the position sizing, money and risk management optimality table. Now, remember I said you need to be able to calculate your risks ahead, know what your worst possible scenario is. And basically what this table helps you to do is, you can enter your currency pair, right? Enter the leverage on the account you're using, because we have different account types, different leverage. And then every trader should know the leverage they are working on. If my leverage is 1 to 1,000, I put, that means this 1 to 200 leverage here becomes 1 to 1,000 for me. If my leverage is 1 to 500, I put it. If it's 1 to 100, I put it here. Now, because this is key, because remember that the margin required for you to enter every trade is based on the leverage you have on that account. So the higher the leverage, the lower the margin required to enter the trade. And in that case, for this kind of strategy to be good, that means I can have 1 million naira and still start with like maybe 0.1 or even a standard loan because the margin required is low, right? But where the leverage is lower, it means the margin required will be higher. So that is why this table is key in you using this formula. So I impute my leverage. By the time I impute the first lot size I want to use, you can see that this table will give you, you can trace your margin. This is done in USD though. So you can trace your margin. So for instance, I want to start with 3 lot size. You can see that this table automatically, I don't need to be calculated. I don't need to understand in-depth leverage, how this margin calculated. I don't need all of that. Once I input the lot size, it gives me the margin required so that I can now go ahead. This margin required, is my balance up to that? So that I can also advise myself, if my balance can carry this margin, if the event where this trade does not hit profit targets from the first trade, can my margin, my free margin, or the remaining margin available, can it carry the next volume of trade? Because remember, the next volume of trade should be higher than the initial one. So you can see where this table makes a whole lot of sense and serves as a whole lot of guidance for your risk management. So that once it gives you the margin and you see that, okay, no, you can now extrapolate, you can now make projections and know that, okay, no, if I start with this lot size, by the time it will pick the third trade, I would have fainted, or I would have landed in general hospital. Then you adjust your lot size. I put in my 0.01, it gives me what the margin requires. Fine, my account can carry it. And then I can make projections that, okay, by the time it has to, so you can see that our worst case scenario was 6 trades, right? That's why you have this color shade here. So that, okay, I know that worst case scenario, it will get to 6 trade. I will now know, okay, at the 6th trade, my margin required would be, let's say, just for instance, please, don't quote me by this. Let's just say my margin required would be 200K. So I was okay, fine. If I have an account of so million, of 2 million, 5 million, that means it can carry it. Then you can now go ahead. So that, remember, the essence of using this strategy is not to go into the battlefield blindly. It's for you to have, you already know what the likely outcome is before you enter the trade. So that's the reason why you must use this table to impute what your volume is, impute what your leverage is, so that you can have an idea of what your margin required is before you enter the trade, so that you will not be high up in the sky and then you are out of jet fuel and you are wondering how to do like an emergency landing and all that. So I think what's left is for me to show us the back testing of this formula, because remember I said it's a formula that we have tested, we have tried and we have tested. So basically, this is what your chart might look like. Let's see. Let me do something. Let me escape this and take us to. You can see my chart right I have. So by the time, this is a real chart, right? I think I have one of those on pounds or JPY. Okay, great. I had it on JPY. Now you can see that trades, you can see my screen clearly, right? You notice that I have 2 trades on this chart. I have a buy trade and a sell trade, and I have a pending order on a buy. And that's because I have entered, it is the same winners trading formula I use. If you can see this, you will notice that I have drawn my Fibonacci from this point to this point. And it was because I started this trade on Monday. So I used data from Friday to draw my Fibonacci. And then it gave me my area of symmetry, which was on 38 and then on 0. So if I zoom here, you notice that my area of profits for sell is below here. Let me zoom this some more. Okay, the candles are tiny, but you see the red lines here are the area of profit for my buy. Now, since I have placed this trade, I am not bothered. All I do is I checked it in the morning. Okay, is it likely to come? I set another pending order because I noticed it had picked a buy on Monday, didn't get to take profit, and then came down, picked the sell, didn't get to my target profit. Yesterday it was in the trade risk zone for a while, came down almost to take profit. So you see that I have both my take profit for the sell here, I have also my stop loss for the buy here. And at the moment price comes here, it will take profit and stop loss simultaneously. Currently, the buy is at 0.05, the sell is at 0.1. You can see it here. That means 2 times the price, the volume of the buy. Immediately price gets here, my net will still be in profit. Now, because price has failed to get here, it came into the weak zone. Today I set, so if I double 0.1, it will be 0.2, right? So that's why I have another pending order here, 0.2. I have a buy stop here for 0.2. So that in the event that price fails to go down and starts to go up, right, it will trigger a buy. That will now make the volume of my buy bigger than the volume of my sell. So eventually, if it travels and goes to hit take profit, so at that point, at that profiting zone for the buy trade, there are 2 orders there. There's a take profit and there's a stop loss. So that once price gets there, it close the buy trades in profit, close the sell trade in loss. Of course, by then I'll have 0.25 loss size on a buy and I'll have 0.1 on a sell. So you see, by the time it nets out, my profit will be 0.15 on that trade. So you see, that way I am not always on my chart. I am not worrying. I am not, it's there. The system, and I have used the system consistently, and it has afforded me what? Consistent profit. And then, you know, the good thing with this trading formula is you can now, over time, after you have tested it, seen how it works, you can now decide to scale it up. I remember the first time we did this, we had this in the Abuja office, quite a number of traders that used to just be all around the charts trying to scalp on every news became more relaxed. Because with that, you can make more informed decisions, and then you don't have to be on your chart looking for every opportunity, pursuing price here and there. All you need to do is to set the trap for price, and then price will walk into it. You know, I used to say this, I say, as price no dey hear word, you go see wetin dey find up and down. I will set the trap for it, so as he's going up and down, he will enter into one or both of the trap. So that's the basic concept for the WTS. Let me go back to the trading slide. We should be rounding up this shortly. So let me just go through the rest of the slides so that we can round up this session. So that's okay. I think I need to give room for questions also. So let me just go through that quickly so that I can answer. I can unmute and then get to answer some questions before I go. So basically, this was just a chart representation. So I wanted showing us on a live chart instead of showing us on an image. That was why I got here. So this is a report of the back test, right? So in testing this day, we actually tested it on 5 different brokers. But as you know, I'll show you the reports. My emphasis is on rally trade, of course. So I'm showing you the report for rally trade. And you can see that we use different amounts to test them and different periods. Now, the reason, aside from just wanting to just show you only rally trade, you notice that it's because also the result was good enough. Because you can see that the profit factor, aside from this, you can see that rally trade gave the next best possible outcome from trading this strategy on different platforms, right? And then it had what? It had 80, the total number of days it was tested was 84 days. And then in that 84 days, the returns was what? About 56.3%. 84 days, let me approximate, let me say 3 months. In 3 months, please, you have made 56% returns on your capital. Please, this is a bad thing. Is it manageable or is not manageable? But you know, of course, those people that already have come with the excitement of wanting to hammer might not think it as reasonable. But the truth is, For those of us that think that, okay, no, we can scalp and we can double up our accounts, I can assure you that you cannot consistently double up your accounts all of the time. One season you will double it, you'll be excited. The next season you will crash it and you'll be sad. So I'm just showing us this to tell us that you can consistently, remember at the beginning I told you that this formula can afford you what? Consistent profit over time. And this is what we have seen here. In 3 months, 56.3%, that is a very manageable amount of profit. That means if you make a projection in a year, you will get up to 244% returns, right? So basically, this is just the trading history to show the graph, to show you the worst possible scenario. So this is like the worst possible scenario. That was like the depth of drawdown it got into, and then went back up, stabilized in the profits. Same thing we have here. Where's that summary from rally to see? So basically, this just gives you a graphical. For those of us that have expected or have tried to look at their chart history from their trading, from their MT4, you have seen a graph like this showing you your exposure and all of those things. So advantages of the WTS trading formula, right? It's what? No more loss. Trade losses arising from adverse market movements is recovered. Because if market runs up, if I have a sell trade and suddenly market runs up, there's a pending order there with a higher volume that helps me to mitigate from that. So it reduces your risk to zero. Consistent profits and growing of trading accounts. Now it has what? Inbuilt positioning, sizing, money and risk management system. Because the truth is, I tell people to learn how to place, buy and sell is very easy. The next difficult thing is how to manage money and how to manage risks. And this trading formula gives you what? Gives you an automatically built and automated risk management system that you can work with. It does what? It boosts your trading psychology. Because the truth is, look at it, every season you are most happiest as a trader are those seasons that you are making consistent profit. So it boosts your psychology as a trader also. It helps you also to venture into other areas of trading, sort like referring people, because most times what stops off most often from referring people is because me myself, I'm not making profit. How do I refer person? But you see, this boosts your trading psychology generally. It makes you want to venture into either training other people, trading for other people, or referring other people to become traders. Now, trades always close the net profit, right? Because both the losing and the winning trade will outweigh the losing trade, right? Net profit increases in proportion to increasing additional loss. Two profit targets, so you have both profit targets. Effective utilization of maximum leverage. So that means you are able to enjoy maximum, because most times traders will say, no, they prefer lower leverage. Charles, just give me 2 minutes, I'll wrap up this and then I'll take your question. Now, it also do what? It's voluminous lot size. Now, I often tell people that, especially those of us that are IBs, understanding this trading formula and teaching people under us gives you, for an IB, the more trading loss you have, the more rebates you accumulate. And this trading volume, this trading system gives a lot of volume, which means a lot of returns for you as an IB. So now, remember I said this training is going to be in 2 parts, right? This is just an introduction telling you what you can do with this trading strategy. Now let me present the class to us. So there's expected to be a hands-on training next week, where we are going to practically, you'll be taught how to pick your Fibonacci, how to draw your Fibonacci, how to identify your area of risk, because that's the key thing with using this strategy. Identifying your area of risk is the first thing. Once you can get that correctly, the rest is just for you to set pending orders and then your take profit levels, right? So we have a training for it next week, an advanced training with the chief market strategies, right? You have this handbook. The handbook will be given to you, soft copy, yes. You also have what? You see that automated risk management table. You also have it. You have an advanced training certificate. Okay, now this tea break and lunch break is usually for the physical class. When we have the physical class, we also have tea breaks and lunch break. But for this particular session, we're going to be having the class online. So the class will be next week, Monday and Tuesday. It's a 2-day course. Next week, Monday and Tuesday, and the time is going to be 10 a.m. and the class will be on Zoom, so that irrespective of your location, you can join in. Now, steps to getting the training. First thing is that I expect that you have an active trading account with Rally Trade. And I'm sure by now, most of us already should. It means you have a trading account with Rally Trade. It means you have trading capital. It means you have submitted your KYC document. Very important. Because sometimes in the course of the class, we might see like trading chances. And then if your account is not active, there's no way you'll be able to take advantage of that position to make some profit for yourself, right? So you need to have an account, have trading capital. Make sure you have submitted your KYC documents for that trading account. Then you need to register for the 2 days. You need a registration. Yes. The training fee for this session is usually 40,000 naira. But however, given that we're having the class online, right? Before some of you start to log out on me, we're going to have the class, the cost fee is actually 10,000 naira. So because we're having it as an online class, we are not going to pay 40,000 naira. 10,000 naira, you register ahead for the class, and the registration is simple, right? You just need to do a payment to the end market account, right? So you're not making the payments to the regular FRNG account you make your deposits to. Now, if you have issues with this, you can just screenshot this and have it, or you can contact your account manager to guide you through on how to make payments. But remember, the full class, the practical class is next week, Monday and Tuesday. You are expected to do a registration and pay a class fee of 10,000 naira, right? And it gets you into the class. So you just screenshot these payment details, or if you cannot get it, later on you can drop me a message. I'll send it to you on WhatsApp, or you can find out from your account manager what the payment details is. And then for those of us that joined in late, my name is Janet Dadel. This is my phone number in case you need inquiries on the payment details later, or you have questions from it. Okay, I still have some 10 minutes. So I'll mute now and answer to some questions. I saw Charles earlier on. So, Mr. Charles, good day.
Okay, good morning.
Good morning, sir.
Yeah, sorry, my question is just on the stop loss, because you didn't really mention about where to place the stop loss. Like for the first one, the first trade, if for instance, it enters a buy trade and it hits your stop loss, you know, you are out of the trade, you lost out. So the other trades that you place on pending orders, they are as good as useless. So how do you mitigate against that? How do you place your stop loss? Because you've not really explained about the stop loss.
Okay, pardon me, I thought I did, but let me show us here. I didn't want to take back the slide. Now, remember I said, so I have identified, for instance, let me use bolder lines. Let me use this. They are bolder. So this in between here is my area of risk, right? So for instance, which was the case in this practical trade, I had a buy stop here. That buy stop triggered, right? My take profit is above, just for ease of. Oh, okay, I'm not sharing yet. Pardon me. Let me share this. Share. Okay, can you see my chart now, Mr. Charles? So this, for instance, is a practice. You can almost Mr. Charles so I can clear this question now. This is a practical trade. I have this trade going on using the formula. It's on GBP USD. I've had it from Monday. So I identified my area of risk here, which is in between these lines. I had a buy stop here, which peaked. But you can see that it peaked, right? And didn't get to my take profit target. Just for ease, let me assume this take profit target. My take profit target is higher than this, but let me just assume, okay, this one is quite clear, so we can see it. My take profit is here. Now you can see that price failed to get to my take profit and started coming down. And then I have a sell here. By the time I have this sell here, right, I will put take profit for the sell here. Then this buy I have here, I will put the stop loss here, which was why I mentioned, this was the reason why I said I have two of these lines here. So these two lines here, one is take profit for the sell, the other is take profit, stop loss for the buy. So that in case price as is coming down, there's volatility and it comes down to this point, it will hit those two lines. One is my take profit for the sell trade, which is 0.1 lot size. The other one is stop loss for my buy trade, which is 0.05. So you can see that 0.01, which is in profit, is heavier than 0.05. So that way, the two trades will close. Yes, one will close at a profit, one will close at a loss. But the one at a profit gives me more money than the one at a loss. So plus and minus net, I am still in profit. Does it explain it, Mr. Charles?
Okay. So you're trying to say the two, both the stop loss and the take profit will be at the same level?
Yes, we are around the same level. Yes, sir. So the same thing, if it fails to take this buy and is going back up to pick, if it fails to go down again and it's going back up, I will pick, and already I have a pending order there for a buy stop there. If it picks this buy, this same buy now, I will put take profit for it up here, and then the stop loss for this my sell will be up there too. So that if price volatility pushes up, it will close both profits for the buy trade and stop loss for the sell trade.
Okay, sorry. So if I'm getting you, all the trades that you'll be placing, you to have both take profit and stop loss?
Yes, sir.
Okay.
Thank you, sir. Who was the next person? Okay, Mr. Emmanuel. Good afternoon. Sorry, I just have about 6 minutes. Mr. Emmanuel, good day.
Good afternoon. Can you hear me?
Good afternoon. Yes, I can hear you, sir.
Yeah, I want to start from where that man stopped.
Okay.
Let me just come from the beginning. He said, you enter a buy from your pending order, and it goes against you going down. Fix your pending order for sell also. You now set your both stop loss for buy and take profit for sell be at the same level down. So when it's now going again, this is where my question is. When it's going up back again, it's going to meet your first buy spending order, right?
Yes, sir. Yes, sir.
Do you mean that you are going to enter another spending order for buy here?
Yes, I'm going to enter another, and you know, I'm using this trade practically because this is a real account. These are trades that I have. I have a pending order for a buy here. So once this GU now go down to hit take profit and stop loss, and it goes up, it will pick another trade, and then it will mean that I have 2 trade and 1 sell trade.
Yes, I want to get it right, which means you'll be having 2 buy trades now.
Yes, sir.
Okay. Now,
and then I have 2 take profits for the buy trade and 1 stop loss for the sell trade.
Don't let us mix together. Now, if you are going, if you have 2 buy trade now, your stop loss for this second buy trade will be where?
The stop loss for the second buy, it will be the same place as this sell.
Fine, I understand.
With the previous one.
Yeah, I understand.
I will use the same price level for all the now the stop loss. I will use the same price level because I want price to close it at the same time. So I won't use different price level, the same price level. Are you still with me, Mr. Emmanuel?
Hello, can you hear me?
Yes, sir. Yes, I can hear you now. Did you hear what I said?
I heard what you said. So you mean that both the stop loss and the take profit will be on same level for all the trades if it's going to 6 trades?
Yes, now I don't want to go further than that. In the class, right, I will teach you to put a little difference. If you can see my chart, you notice that there's a little difference, right? It's so amount for spread. That's why I've done that. So I don't want us to bother our head with this. We'll do that in the class next week. So yes, they will be at the same level. So all the stop loss we have the price might take up to have the same price.
Yes, let me continue my question here.
Okay,
from
sir.
From that second pending order, when it's going up, when it did not, okay, that second order, the stop loss will be greater, will be more than the sell stop loss, right?
Are we talking about the stop loss now or the amount?
Stop loss now. The stop loss for your second buy pending order will be more than the sell stop loss.
They will be the same price level, but because their lot size is bigger, the amount will be more. Do you understand?
I understand.
So it will be bigger, but the same profit, same price. And the stop loss the same price.
You don't get what I'm saying now. I'm talking about lot size now.
I don't. Lot
The lot
size. I don't have lot size.
Second buy
Buy
order
trade.
sell
It will be bigger, sir.
than the sell, right?
Yes, sir.
Okay.
You remember that table I showed us? The lot size is incremental. It keeps doubling. This trade, second trade.
Okay. Let me now go to my last question now. Now,
Okay.
let's see the second pending order is going up, and it did not reach the take profit, and it's coming back down again. So, if we get to the sell side, which we are going to enter another sell with higher
Yes,
loss
sir. Yes, sir.
and set all the take profit and stop loss the same level.
Yes, sir.
Okay.
Okay. Thank you. Okay. I only have time for one more question because I have only 1 minute left. Now, the number is displayed, right? Let me go back to that number. It's also my WhatsApp number. So you can drop me WhatsApp messages. You can drop me images. I will take out time to explain. If I need to do a voice recording or a screen recording, I'll do it to drop it for us. Is that okay? Are we still there? Let's see. Or you can also type the number on the chat so that. Just type my number on the chat just in case. I'm trying to share about that screen. Okay, I'm really sorry if I didn't get to take your question. So that's my WhatsApp number. You can drop me. If need be, I'll do a screen recording, make illustrations and all of that and drop for you so that you understand the concept. But trust me, by the next class, we're going to do this. It's going to be more practical. If we're telling you Fibonacci, you ought to be able to also follow with those lines and see all of those levels at the same time as the class is going on. You can meet everybody. So it's 12 o'clock. I really have to leave the class now so that another class has been scheduled for 12 o'clock, right? So you can't hear the audio. Okay, so thank you very much. Remember, you can drop your inquiries, register and make payments for the class. You can ask questions from your account managers or drop me questions on WhatsApp. Thank you very much for staying tuned this long. Thanks.